Are you struggling to decide on the investment strategy that offers the highest returns? If you have a low risk tolerance and are unsure whether to opt for value investing or growth investing, this video is for you, especially if you are new to investing and looking for clarity in these concepts. In today's video, we'll do an in-depth comparison between value investing and growth investing. So ensure you stick to the end, because what you're about to learn in this video might just be the jackpot you need for financial freedom. Ready? Let's dive in. Value investing. Let's start with value investing. Value investing is an investment strategy that was popularized by Warren Buffett, although the conception was brought to birth by Benjamin Graham through his book, The Intelligent Investor. Value investing entails buying shares that are selling for prices that are below their real potential value. Such investment involves searching for undervalued and underpriced stocks, buying them, and holding them for a long time until their values become known, and people are ready to pay a fortune to have them. Value investors look beyond a company's present performance before investing. They do not jump out in haste to make decisions or follow the trend. They take time to do their homework adequately and ensure they foresee a better future for that company before investing. Value investors ignore the efficient market hypothesis, the popular hypothesis that the value of a company can be determined by the price of the stocks, which is something that value investors do not buy into. Why? Because value investors know quite all right that a company's stock can be undervalued, underpriced, or even overpriced. They know that various factors can cause the stock of a company to be sold for a price that is far less than its intrinsic value. They also know that the future of a company is more important than its present, which is why they ensure that they only invest in companies that have the potential to do better in the future, even if their current state is discouraging. So, if you are considering going for a value investment strategy, it means you are going for a not-so-popular company that you know is doing quite well. Value investors do not invest in popular stocks based on the opinions of other investors. They are not looking out for those big names in the stock market. They'd rather go for what others would pass off, since they cannot see how investing in such companies would be beneficial. How can you identify such companies or stocks as a young value investor? We'll talk about this shortly, but before then, let's examine the other investing strategy. Growth investing. Growth investing is a strategy focused on buying shares of young, early-stage companies experiencing rapid growth in profits, revenue, or cash flow. Investors who adopt this approach prefer capital appreciation or sustained growth in the market value of their investments, rather than the steady streams of dividends sought by income investors. Tesla, Amazon, and Facebook are very good examples of growth companies in the market. They mustn't necessarily be upcoming companies. There are also even older, well-established, less tech-savvy companies that can be considered growth investments. For instance, Home Depot is categorized as a growth company. Understanding the life cycle of companies is essential in understanding growth investing. In the early days of a new company, everything grows at a rapid pace, resulting in impressive revenue and profits. During this phase, companies usually reinvest profits back into the business to drive further growth rather than paying them out as dividends. As the company and its markets mature, revenue and profit growth decrease or remain flat. Once the company is fully mature, growth slows further. It's often at this point in the cycle that many companies begin to distribute profits to investors in the form of dividends. This cycle does not often last 10 years. On the other hand, you can hold on to value stocks for a lifetime. In case you're still confused, growth investing seeks out companies that are growing their revenue, profits, or cash flow at a faster than average pace, while value investing targets older companies priced below their intrinsic value. In other words, growth investing, as the name sounds, is based on what's trending or the company's growing results. It's all about going for the evidence that you can see now, while value investing is based on what is less popular and what you can foresee. With the simple definition given, you will realize that the growth investment strategy requires a lot of caution. Why? Many investors often think that this strategy comes with a lot of risks. Think about it. Why would anyone decide to take a risk and invest in an upcoming company that has a track record of success? Yet, growth investing seems to be a more reasonable option than value investing. In the past, value investing has generally performed better than growth investing over the long term. Yet, in recent years, growth investing has shown superior performance compared to value investing. According to a recent article, growth investing has outperformed value investing in the last 25 years. Specifically, since 1995, value mutual funds yielded a return of 624%, whereas growth mutual funds showed a return of 1,072%. It is crucial to note that different strategies work for different people, and highlighting growth investing in this video does not guarantee that using the growth investment strategy on your investment portfolio will magically send tons of dollar notes into your bank account. Understanding your financial goals is probably the key to knowing which trading strategy to use. However, for people considering making a high return on investment, growth investing might just be the one that cuts it. But then, how do you choose the right companies as a growth investor? How to identify stocks. As a growth investor, it's important to know that not every new company can guarantee a high return on investment. And this statement is true regardless of how in demand the company's industry might be. Let's take a very relatable example. In the world today, the biggest industry might most likely be the tech industry. And as an investor, you will most likely see 1 billion companies associated with the tech space. This, however, is not a guarantee that your investment in any company in the tech space will automatically yield results. That's why you must follow a few outlined principles when choosing a company to invest in. Historical growth. Historical growth might seem vague or unreasonable because the companies you are willing to invest in are new. However, considering the historical growth of any company is one of the key determinants of a good investment. And here's why. No matter how new a company is, there is always a growth pattern associated with the company. As a potential investor, your job is to research the company and follow through its growth process over a period of time. This could be on a yearly basis or even a monthly basis. The records give you an idea of what to expect over another period of time. Return on equity. This simply refers to the revenue generation of the company based on the money investors like you have put into it. Fortunately, or unfortunately, depending on your love for basic calculation, you can use a rather simple formula to get this. The return on equity can be calculated by dividing the net income by the shareholder equity. Simple, wasn't it? What is left for you is to compare the numbers in the last 2, 3, or 4 years. If you get stable or greater numbers, it shows that the business is doing well. However, if the reverse is the case, that is already an indication that investing in such a company is bad business. Profit margins. In this case, we tend to consider how much money or profit a company makes over how many goods or services it sells to the public. Some companies might have very good sales, but very low profit margins. Some top companies with low profit margins are Tesla, Targa Resources, and Occidental Oil. If the earnings are lower compared to the huge sales made by the company, then the company is struggling with cost maintenance and revenue. Stock performance. As a stock investor, what you obviously want to be looking at is the stock performance of whatever company you're willing to invest in. This gives you an idea of what you should be expecting in the next couple of years. If a company's stock does well on the charts by producing at least a 10% growth value over a minimum of 4 years, then you can consider it a good investment. However, there is still the need to check other factors and double-check before taking any reasonable action. Forward earnings growth. Forward earnings growth is simply a publication made by a company showing their earnings for a period of time. Usually, it shows how much the company has earned at the end of a fiscal year and probably the following year. The numbers shown are used to analyze the company's performance when it comes to making a profit over a period of time. As an investor, you can take full advantage of this publication to ascertain which companies have a growth potential above the current rates. A not so relevant fact is that these publications are made quarterly. So, study the last few quarters before making any financial decision. So, Having dealt with the various ways a growth investor can choose a company to invest in, let's explore how to identify underpriced stocks as a value investor. Identifying undervalued stocks. As a value investor, growth investment strategy gives an investor an extra edge over value and dividend investments. 1. Analyze the company's historical performance. Value investors like Warren Buffett know that buying a company's stock is equivalent to buying a part of the company. They understand that they can only get value from their investment when the company performs well. That is why value investors prioritize analyzing a company's performance before deciding to become part of it. Warren always considers the company's ROE, return on equity, to see if it has performed better than other companies in the same industry. The ROE is the returns the stockholders get on their investments. Don't just analyze the ROE of a year, but rather for at least 10 years. A company may perform well in the last year, but might not have a notable record of success, and that might be a red flag. If the ROE of a company for the past 10 years looks good enough, then you can invest in that company as a value investor. To calculate the ROE of a company, you have to divide the net income of the company by the amount of equity paid to shareholders. 2. Analyze the company's debt-to-equity ratio. A company's debt is the amount it owes, while its equity is the amount it has. This is an important aspect of a company that Warren Buffett considers before buying into it. He prefers to invest in a company with little debt, which means that earnings growth comes from shareholder equity rather than borrowed funds. When the company's debt is higher than equity, definitely, earnings growth is generated from borrowed money. A company that operates exclusively on borrowed funds and lacks a means of increasing its equity beyond its debt is not one that value investors consider worthy of their investments. You might wonder how to determine a company's debt-to-equity ratio. This is calculated by dividing the company's total liabilities by the shareholders' equity. 3. Check if the company has a good and increasing profit margin. This is another thing every value investor does. They determine the profitability of the company by looking at the profit margin. This is calculated simply by dividing the net income by the net sales. It is not enough for a company to have a good profit margin. The ability to constantly increase the profit margin is an indication that the company's management is on top of its game and that it has been controlling its expenses well. To determine the company's profitability, you need to look back at the profit margin for at least 5 years. Ensure there is a consistent increase in the profit margin every year. If that is the case, you can invest in such a company. 4. Ensure the company has a moat. A company that does not have a future is not worth investing in, which is why value investors take this point seriously. Before investing in a company, you must be able to study the company's commodity and ask yourself the following question: will this commodity be relevant to humanity in the next 5 years? If the answer is no, then don't invest. If the answer is yes, you need to take your analyses to the next level by asking again, does this company have what it takes to scale above opposition? Or, how does what this company offer differ from that of its competitor? How do they stand out? What will make them survive in the competition? Will there be a better product that will push this product out of the market? All these are the primary questions you must find answers to as a value investor. A company that does not have a competitive advantage is not worth investing in because it can be edged out of operation any day, anytime. The success of a company largely depends on its management. Look at the history of the company for the past 10 years. Check all the evolution and expansion promises of the management and see if they were able to fulfill those promises. If they were able to deliver what they envisaged, then you can trust their promise of a better future for the company. Now that you have a concrete understanding of how both investing strategies work, which is best for you? Growth investment versus value investment strategy. Growth investing has always proven to be a better way of securing a better financial future, and here is why. Growth investing offers a high return potential than the overall market. The companies invested in usually lead the forefront of new innovations, making their goods or services of higher demand. These companies also offer competitions to existing companies, causing a shift in profit margins. Growth investing offers a short-term profit-making plan for investors. Imagine investing in a new company that is into a new technological innovation. and in a matter of 5 years, you catch out to reinvest in another promising company. That's a cool way to flip your capital and catch out before the company begins to go down. Who wouldn't want higher returns? Growth investments, despite the higher risks posed, offer higher returns, which is basically what every investor desires. Thanks for watching this video. See you in the next.